It's our Friday week 3 update video. This is Professor Hassey. It's Business 6:30, and this video will be posted Saturday morning, November 13th. So I want to welcome everybody. Hope you're doing well with the case number 1 that is due this Sunday. We had some good questions and discussion on that in our student hours this past Thursday. If you did not attend, I am available this weekend should you have any questions or concerns about case number 1. Our topic today is learning how to use or seeing how to use research capabilities that we'll be using this class. I'm going to go over the D&B Hoovers database in the Laverne Wilson Library, talk to you a little bit about that. And also just a final little discussion on stock valuation and take a little bit final look at how to calculate and understand stock pricing. First of all, as I just said, don't forget your case analysis is due this Sunday. It's an analysis that requires you to do some calculations and go to the internet to look at some information, but primarily it's there to give your interpretation of the risk of your particular chosen company in the market. For any of you who have concerns about the format, there's a sample paper provided in Blackboard that you can review and use that as a guide in putting this paper together. But the key thing, as I've mentioned before, is to see your way of interpreting and analyzing your explanation of the risk of a particular company that you have chosen. I'm looking for your interpretation, your analysis. It does not require too much outside review as far as detail or numbers, but it does require you to have a knowledge of the company's status in the market, in the industry, in their own organization. So hopefully you can put that together. Again, it's an APA format. I accept it in Word processing or in PDF. If you do use Apple, if you use your Apple as your way of doing the work, please convert your Apple file before you post to Word or PDF. It just makes it easier to grade when all the formats are fairly similar for my Dell desktop computer, even though I do have an Apple computer, but most of our students do use Word or PDF formats, preferably Word. So please, if you do use the Apple system, please convert your file, or once you save your file, to a Word format. I would appreciate that. Finally, when you do post your casework, make sure your name is in the title of the file that you post. Yes, your name will be on the title, in the file as part of your paper, but also put your name on the file title in your file when you post it to Blackboard. That makes it easier for me to know who's who. I have a lot of papers and work coming in, so it makes it a little bit easier and gets me to get the work back to you quicker as far as a grade. So if you could take those into consideration. Okay, now you can see on your screen the University of Laverne website, which I hope you're somewhat familiar with. But another aspect of this website, it gives you access to our university library. And if you go under academics in your website, and at the very bottom of that pull down menu is Wilson Library. Click on Wilson Library and it will give you the Wilson Library here on our Laverne campus. But all of you students in our remote and regional campus areas all have access to this. And you go to the database menu, click on databases, and it'll bring up all kinds of databases by subject that the library offers to our students. You want to go to the business subject matter right here, business, click on that. And again, that lists a lot of different databases that you can use as a student, especially as a graduate student, to do research. Before I show you the database that I have chosen and will use in all my classes, the D&B Hoovers, I want you to take a look at this person here shown on this site named Linda Gordon. Miss Gordon is our university librarian for business students only. If you have any difficulties getting data, if you have any difficulties writing a paper, if you have any difficulties just doing research or doing the work that Professor Hasse gives you, Miss Gordon is the person to contact. You can call her, you can email her, you can sign up for an appointment online. She is the person who knows the type of material I study. She knows the way I like material to be given. And she is a great expert as another source of information in your research of information. So make sure you know, and also she helps you in any courses that you take in the MBA program, Miss Linda Gordon. All right, now the database that we use, or the use of preference for this professor, is D&B Hoovers. So right here is D&B Hoovers. So you click on D&B Hoovers. And first I'll ask you to log in, okay? You'll have to log in with your email address. And this is make sure, because this is a database that's reserved only for students, so non-students cannot get into it. So you type in your Laverne email address and your password to get in your email, and you sign in. Here it comes. And it gives you research tips. You can scroll through that, get rid of that. And up comes the main page of what you want to do, okay? And you can browse news, you can analyze markets, find contacts, research industries, all kinds of information. But mostly what we're concerned about here is to find a company, okay? So you search and build a list. You search for companies, click on companies, and up will come their search engine, okay? What you want to do is just type in a company or information that you want to know about a company size, and this gives you a variety of things. But basically, this is a way of doing a search where you don't know what company you want to pick. But if you already know your company, so you go back to the desktop, get rid of that. And right up here at the very top, it says search for company. So let's say I'm going to pick, I like to pick all this time because not too many students work on it, is Ford Motor Company, which is one of my all-time favorites. And so it brings up a list of all different types of companies that name Ford, but it's usually your company is right at the top of the list, Ford Motor Company. You click on that, and up will come everything you always wanted to know about Ford Motor Company, but were afraid to ask. It gives you a link to their website. It gives you information about the company. And then over here on the left-hand side is the most important thing, all different types of information. Company summary, description, history, their products, their corporate financial overview, a SWOT analysis currently of the company. It gives you their competitors, SEC filings, annual reports, and their financial information, ratios, everything. Their income statements, balance sheets, everything. This is where you want to go if you want to find information about a company, and it's at your University of Laverne website. So again, it's D&B Hoover's database. It's an excellent source. I use it even though I'm not getting an MBA or anything. I use it because, yes, I'm a faculty member and I have access to it. But if I was an alumnus, you have access to this for the rest of your life. And it's a great tool to research if you're thinking about investing, if you're thinking about interviewing with a new company and you want to find out all about it. Good thing to do your homework beforehand. If you already work for a company and you want to find out some information about the company you work for, this is a database of all publicly traded companies. So naturally, no private companies will be here, but it gives everything you want to know financially, analytical wise, the company, their ownership, who gets paid what. It's a wonderful, wonderful source of information. So D&B Hoover's database, please take advantage of this in all your classes. It's a great source of doing research from your desktop in your courses. Okay, one last thing for our Friday update video. I hope, and please take advantage of that D&B Hoovers. It's a great resource, especially for graduate level courses, when sometimes your professors don't give you much information about how to do a project or where to find the information. This is a great macro source to narrow down information about markets, industries, and specific companies. So please take advantage of that. And if you have any questions on that or having any problems with that, either contact Linda Gordon, who I mentioned, or please contact me. All right, the last bit of information for this week, Friday, before we get into week 4 next week. There's no graded work next week, no case study next week. Next week, we're going to be bringing up an old friend of ours from prior classes, maybe capital budget analysis. And some of the information we've studied these first 3 weeks lead into that. Naturally, I talked a little bit about in my Monday lecture video, the cost of capital, more specifically, the capital structure and the cost of equity, determining the return on an expected investment in a stock based on market indicators of zero risk, the risk-free rate, average risk or beta of 1, market return, and then the specific company beta. And then you can determine what you as an investor or the company can determine what them as managers have to make sure that they meet these required returns in order to satisfy the needs of the market of investors who want to invest with them. Well, to get even a little bit more specific on that, I want to go to the second tab in this spreadsheet in week 3, and it talks about specifically stocks. And again, most of you are familiar with this, but just some broad strokes. Remember, there's 2 ways of getting a return on a stock or equity investment. You can get a dividend, or the price of the stock will go up or down. Hopefully, in your case, the price will go up. A dividend is called yield. It's the amount of dividend that a company pays. Now, naturally, some companies do not pay dividends, but most companies do, especially most major corporations. If you're in the Dow, index, if you're in the S&P 500 index, if you're in the NASDAQ index, most companies pay dividends. But some companies, during certain types of periods, during certain times of their growth rate, or during certain types of their way they're operating, sometimes they do not pay dividends. And you have to be aware of that as an investor, but also aware of it as how that equates to the value of the stock. Investors want to own companies that pay you return. And if you're getting dividends as well as the stock price going up, you're going to be very happy. So the annual dividend yield of a stock is the dividend that the company pays divided by the stock price. And that's called a dividend yield. The combination of dividend yield and stock appreciation, better known as capital gain, will give you the total return of a stock. All right. So let's say I have a dividend of $4 with a yield of 20%. That's good. But also at the same time, if I have a 2% gain in the stock price over a period of time, that's a 10% gain. So if I take a combination of my yield and my gain, I would have a 30% return on that stock during a particular period of time. That's an important thing to know, not only as an investor, but it's an important thing to know as a manager or a financial manager of a company. Remember, part of the reasons why you work is you work for the ownership of the company, more specifically the board of directors and the stockholders. And if you're not giving a yield or some type of return or a share of the company growth to these individuals, they're either going to do 3 things, and maybe all 3. They're going to fire you and find somebody else who can meet their demands to get their return. They're going to change management, which happens quite a bit. Or they're going to sell the stock in the public market, get rid of it. Or even the worst of all the 3, they're going to sell their stock to somebody who's going to take over the company. And that's, a lot of companies don't want that, or you have totally new management and ownership of the business. So that's why this is especially important to know as a financial student, is making sure you understand the importance to a manager of getting return in the form of either dividends or stock growth to that company. And another area of a stock is also anticipating how you think the stock will grow over time. And there's a famous famous equation, a famous theory in finance called the constant growth model. And I'm sure a lot of you have heard of this before, but the constant growth model has been a theory of determining the future value of a stock price. Sometimes people call that the intrinsic value of a stock price, by taking its anticipated dividend in the next year and dividing it by the expected growth of the company minus the expected return of the company. Okay, future dividend divided by expected return minus the expected growth. I said that the wrong way first off. For example, let's say in the next year, a company decides to pay 75 cents a share. Okay, in the next year. Now remember, all public corporations every quarter are required by law to give their estimated return over the next 12 months. It's required by law. So let's say I'm thinking about buying this stock and it's at they tell me that they're going to pay a 75 cents a share dividend over the next year. That's what they expect. Doesn't mean it's going to happen, but that's what they expect. And also let's say I do the cost of equity analysis that we talked about in the first part of this week. And my cost of equity analysis tells me that I expect a 9% growth rate on the company stock this year. In other words, based on the market, based on the risk in the market, I anticipate a cost of equity or expected return on equity to be 9%. When the company gives their 12-month analysis of projected return, they always say, we expect to pay 75 cents in dividend, and as in this example. And also they say, we anticipate the company to grow at a 7% rate. In other words, we expect a 7% growth rate in profit, sales, etc. Well, with that information, okay, I say, okay, if I take 75 cents and divide it by 9 minus 7, which is 2%, if I take 75 cents and divide it by 2%, I get $37.50. In other words, using the constant growth model, and I'll tell you about the negative side of this in just a minute, but using the constant growth model, you can determine that based on the company's projections and my expectations of return, this stock at the end of 12 months will have a value of $37.50. Well, let's say I call up my stockbroker, and my stockbroker tells me today, when I did this calculation, that the stock is currently selling for $40 a share. What would you do? Well, I'd look for another company, because if the stock is currently in the market at $40 a share, and my expectations of return and the company's expectations of their return in the next 12 months tells me that the stock is valued at $37.50, that means this stock is immensely overvalued in the market today. The market thinks this company is worth a lot more than what their projections and the risk in the market says it is. So I would stay away from that like anything. But if also on another example, if I call up my broker and my broker tells me, Rick, the stock is currently trading at $30 a share in the market, then I would say, $30 a share, that will give me a nice $7.50 return on the stock. Maybe I'll go ahead and do that and buy it. So again, the constant growth model is used in a lot of modeling by brokerage firms to give you an idea of what the stock is potentially going to be in a year, its intrinsic value, in relationship to its value today based on expectations and return projections by the company. It's called the constant growth model. Now, the downside to this is it's constant. Many times companies anticipate paying 75 cents a share, but they don't. And it might be lower, it might be higher, it might be inconsistent. And also another thing, constant, these expected returns can change from one quarter to the next. So today it might be $37.50. In 3 months, it might be $34. That's the inconsistency with this, and that's why we have changes and swings in the market, because companies change over the course of 12 months, their expectations, their returns. So, but again, the constant growth model is a way of putting a stake in the ground, taking a look at today based on our expectations of return, based on the risk in the market, based on the company's projections of 75 cents a share and 7% growth. And basically, it gives us an idea what that company will look like in 12 months. Again, it's not a bad thing, but you have to understand there are some negative sides to it, because being consistent, knowing that the market will change. But again, it can give you an interesting view of that. So please pay attention to the constant growth model. This is a model that is used to make a quick and dirty analysis of a company and their expectations. And what I mean by that is that leads us into next week's week number 4, when we start investing in assets and expecting a return on that investment over the depreciable life of that asset. Will that supply, that return of that particular asset investment, supply the return that is demanded by our investors in the market, so we can keep them happy and keep investing? Because remember, even though debt has nothing to do with this as far as the equity side, debt is influenced by the performance of the equity side of a company. If a company meets their dividend requirements, meets their expected growth, the stock price is growing at a rate that the market and the investors expect, then that's going to also make a good representation in the credit markets to keep interest rates down, to get more money from banks or bondholders, because they know you're running your company efficiently, meeting your demands of the investors on the equity side. They will make capital available for you on the credit side. So both of them go hand in hand, and we're going to discuss this at great length in strategic decision making as we begin week 4 on Monday. So that's where we stand heading into at the end of the first, first third of our class, even more than that. Yeah, a little bit more than a third. We've now taken a look at the credit markets, the equity markets. We've learned a definition of risk and return. And now that we have this under our belt, we've done a risk analysis in case number 1. Now we take that risk assessment of our company and now invest it in assets to expect and calculate an expected return through a capital budget analysis. And once we do that, then we take a look at analyzing the results and how those trends look to making future strategic decisions in our company. That's what we have coming forward in the next few weeks. So thanks, everybody. If you post your case number 1, I'll have the grades posted probably by Tuesday of the coming week. But look for my Monday video talking about capital budgeting analysis. I strongly urge you to fire up your spreadsheets, because for the next couple of weeks, we'll be doing a lot of spreadsheet work. Case number 2 is a spreadsheet formatted problem. All right, thanks a lot. Have a great weekend, everybody. Stay safe, and we'll see you next week. Adios.